Hello everyone, this is the tutorial on constructing the portfolio efficient frontier using the Markowitz model. The template for constructing the efficient frontier is available on the website in the tab Markowitz. The problem is already outlined and some of the inputs have already been entered and some of the formulas have already been presented in this template as well. All you have to do is fill out the green shaded areas for the annualized expected returns and the annualized variance covariance matrix in here. The steps to arrive to the efficient frontier are outlined to your right. So the first step, we have to make sure that the formulas are correct and the expected returns and the variance covariance matrix are in annualized forms. So you can see that here we'll put our percentage expected returns, and here will be our annualized variance covariance matrix. Our variance terms are simply the weighted sum product of the weights determined for each stock, which will be determined by the software, times all the covariances of stock 1 with every other asset. If you look at the second term, similarly, it's the weighted sum product of the weights for each stock by each of its covariance terms with all other assets. The variance of the portfolio is simply the sum of the variance terms, and the standard deviation of the portfolio is the square root of the variance of the portfolios. For the return terms, it's a little bit easier. It's just the weighted expected return for each of the stock with the return of the portfolio equals to the sum of these return terms. Essentially, the return on the portfolio is the weighted average of its individual returns, where the weights are determined for each of the assets in the portfolio. So our next step is to generate the expected returns and to generate the variance and covariance matrix. The data for this example, I'm going to use the data that I already have. I have 5 stocks. The data runs from 4th of January 2011 and until March 2014. These are the daily return data. So first thing, I will calculate my average daily returns, and to do so I'm going to use the formula average in Excel and select the stocks. Notice that we don't need to use the market index for the Markowitz optimization model. So this is my average daily return. I can simply copy the formula reference for all other stocks. Now the requirement is that we have the annualized returns. So my annualized returns is simply going to be the daily return times the annualization factor, and I'm going to use 250 as the number of trading days in any particular year on average. These are my annual average returns for the 5 stocks. You can see that over the period 2011 to 2014, on average, every year, each of my 5 stocks have given me quite nice returns. The lowest was 14% and the highest was 18.7%. Note that my data starts from 2011. The reason for that is that I could obviously get a longer time series of my data, but I wanted to avoid the years 2007, 2008, 2009, partially 2010 as the years marked by the global financial crisis and the consequence of that crisis. The volatility in the markets was quite high, and I do not believe that this excess volatility will be evident in the forthcoming years. So this is the reason why I excluded the years from my analysis when constructing the historical averages for the Markowitz model. These average returns could now be copied into my Markowitz model setup. I can actually make them in a percentage form with a few decimal points. This is a much better representation of it. Now we are off to constructing variance covariance matrix, and the quickest way to construct the variance covariance matrix is through the use of the data analysis plugin, and there's an option for the covariance. Clicking OK, and for the input range I just input all of my columns with the returns for all of my 5 stocks that I'm analyzing. You could include the labels if you wish, but if you do include the labels, make sure that you click on the labels in the first row in your data. Since my selection does not contain the labels, I'm going to exclude them for now. The output, the output will be just below my average returns that I had in the beginning, so I'm going to output it here. Click OK. This is my variance covariance matrix. Again, this matrix is in its daily form. First thing I have to do is to make sure that this data is converted to its annual representation. Again, I'm using a factor of 250 number of trading days in any given year on average, and I'm going to copy it for all of my stocks that I'm considering. Now you can see that this matrix is not complete, as there are some missing elements in the upper right corner, so I have to fill out these values, and since the variance matrix is symmetric matrix, I'm simply going to make sure that I'm copying the correct numbers as I go along. Okay, so the matrix below, the selection that you see on your screens, is the annualized variance covariance matrix. I'm going to copy this matrix into my variance covariance template, values only. You actually don't need to see all the numbers here, so we can reduce the amount of zeros that we observe by making it 6 or 4 decimals, whatever you prefer. Now we are actually ready to run solver for the first time and get our first point on the efficient frontier. Let me make it a little bit smaller so I can see the graph, and perhaps move the graph a little bit up. I guess the first point that could be plotted is let me just go in the solver and explain what is going on. So the Markowitz model sets the objective, and my objective is the cell I14, which refers to the variance of the portfolio. You can as easily set the objective equals to the I15, which is the standard deviation of the portfolio. It wouldn't make any difference. The objective is the variance, and I would like to minimize the variance by changing the cells B3, F3. If you look at the B3, F3, these are my weights. So the software will alternate and attempt to try different numbers in these particular range of cells, which are the weights of the assets in the portfolio, and come up with a solution which will give you the minimum value in I14, which is the variance of the portfolio. I did impose some additional constraints. My first constraint is I16 equals to J16. The reason for that constraint is that the return on the portfolio that turns out to be will have to be equal to the target return that I want it to be. So in order to trace the efficient frontier, I will have to set a return to 16, 15, 14, 13, and so forth, and get the portfolio for that level of return with the minimum variance. So this is why we have that particular constraint. So as you can see, we will be changing the target quite often in the range from the minimum return that we have, which is 14.16%, to the maximum return on the asset, which is 18.77%. So these are the limits of what we can get in the portfolio constructed without short sales based on the 5 stocks with this return characteristics. My other constraints are that weights cannot be greater than 1 and weights cannot be negative. So essentially this constraint limits me from short sales. And my last constraint is H3, which is the total or the sum of all the weights of the assets in the portfolio have to sum up to 100%. These are the only constraints that I make. So before running solver, let me set the target first. I'll set the target to the lowest return available among all of my stocks. The answer that I would expect solver to give me would be 100% in the stock 5, which has 14.6%. That would be the lowest point on the efficient frontier. So I will go back to solver, run this problem now, and the solver says that it found a solution and all constraints and optimality conditions are satisfied. I will keep the solution, agree with solver that this is a correct solution, press OK, and as you can see that the answer that we got is actually what we expected in the beginning. All other stocks will be 0 except for the stock 5, which we would invest 100%. It has expected return of 14.16%, and thus 100% of that stock equals to the 14.6% for the target portfolio that we achieved. I've already created a template for you that you can simply copy and paste special into the output, and your first point appears on the graph already. So I will try the point with the highest return, 18.7. Again, the solution that I expect from the solver is to have 100% invested in stock 4 and 0% in every other stock. Running solver with exactly the same set of constraints, clicking on solve, making sure that the solution can be established, and the solution is as expected, 100% invested in stock 4. I paste special, and I got my highest point. So this is the point with standard deviation 19.79 and expected return of 18.77, where we invested 100% in stock 4. This is the one where we have 100% in stock 5. So what you can do now, you have to populate your graph with the intermediate points. I guess the next point we can try is 17%, because it looks like it's somewhere in the middle between these 2 points. So I'm going to put 17%, go into the solver, run the solver, get the solution, copy my solution into here. So we got an intermediate point. So now we can find an intermediate point between this intermediate point and the lowest one, and it looks like it's going to be 15.5%. So I'm going to change my target to 15.5%, run the solver again to get the point, the optimal or efficient particular case. I got the solution, copy solution, and paste special values only. I got another point here. We're going to keep repeating this and change the target every time we need a new point. For example, it looks like there's a lot of empty space here, so we would want to have a point somewhere here around 18%. So let's see what happens when we set the target for the portfolio equals to the 18%. Solver found a solution. We copy the output, percentage breakdown and statistics for our portfolio in our plotting area, and we have achieved that particular point. I could try point 16.3, and it looks like between these two. So let's try 16.3. Go to Data, Solver, run the solution. Take the output from this solver run, paste it into our spreadsheet, and we got another point. So all you have to do is you continue to populate your graph with more points, and once you have a sufficient number of points, perhaps 15 or 20 points, you will be able to perform further analysis.